Welcome. My name is Van Richards. I'm a chartered financial consultant, and today we're talking about a Canadian company called Enbridge. Just a reminder to stay tuned at the end of today's presentation for an important disclosure. So let's go ahead and begin with the daily stock analysis. Thank you for joining us. And if this is your first time, go over there and hit the subscribe button, hit the like button so that you get updated on new information, on new content that we put out on a regular basis. And as I begin in today, I want to remind you that if Christmas has left you financially frustrated, then you probably need a financial plan. Go over to Richard's Financial Planning and learn more about the financial planning process called the Prosperous Planning Process. So the stock that we're talking about today, I've talked about the concept of a tortoise and a hare in the past days. And the whole idea of this concept is to focus on stocks that have certain characteristics. The tortoise stocks have a strong balance sheet, where the hare stocks actually have more potential, but they also have greater risk. You're going to find out that when we're talking about Enbridge today, it is an agile stock. It's an agile hare stock that goes into that particular portfolio. But remember, just like any portfolio, you want to remember that the past performance is not going to be a guarantee of its future results. But let's learn just a little bit about what Enbridge does. We know that it's in the oil and gas industry, but what exactly does it do? Enbridge has a business mix which is primarily crude oil transportation. It has gas distribution and gas transmission. They also have renewable energy. It's a quality company with quality assets. When I say quality assets, what I measure that by is actually the length of the contracts. The length of contracts with Enbridge really is their forte, and they are generally in between 10 and 30 years. The stock itself ended down today about 1.33%. They're at about $65 billion. And remember, when we're looking at any stock, we're trying to determine its stability, its earnings, and its competitiveness. And when we start with Enbridge, Enbridge is a wide moat company. What do I mean by a moat? A moat is that economic barrier that's between a company and its competitors. And Enbridge hits all cylinders. It really does very well from the standpoint of moat characteristics. They have proprietary assets, which basically it's going to be different than maybe a technology company's proprietary assets. Its proprietary assets are its pipelines. It has a cost advantage because it's really the only game in town. Even regulation gives them the opportunity to almost have a monopoly in itself. The switching cost is really significant too, because it's not like they're going to have competitors that are going to come in and build a pipeline right beside them. That's one of the biggest advantages of a midstream company is they don't have a lot of competition. And then the size advantage is significant too, because when we look at Enbridge, Enbridge has the largest pipeline in Canada. It's the Canadian Mainline, which supplies about 70%. It actually transports about 70% of the oil for the whole country. When we look at what happened in the past year with earnings, that's a big thing too, because even though that the oil industry has been down, now don't get me wrong, Enbridge has been down too, and you're going to see that it's been down quite a bit in some particular areas. But what we're trying to do today is determine how well it can go forward and what its possibilities are. The earnings for the 2020 for the last quarter were $9.1 billion. They quote them actually in Canadian dollars, and we put it as millions here. That is going to be down from last year's third quarter, which was at 11.6 billion. I'll go ahead and put it into that terms. When we look at other earnings in itself, the 9-month revenue, when we back it up just a little bit, and we look at 2019, they were about 37 billion compared to 29 billion, which is a 23% decrease. Going a little bit further, and we look at the earnings per share. Earnings per share in 2019. Now, I've actually got this reversed. If you're looking at this on the screen, if you're listening to it, listen to what I'm saying rather than what you're seeing, because this is reversed. The 2019 earnings per share was $2.27. The 2020 earnings per share was 60 cents per share. It was down 74%. So that's a significant difference. So we have to look at what's the possibilities of this stock going forward. When we look at the third quarter earnings, that's really where we're starting to see some changes go along with that. The 2019 third quarter earnings were 47 cents. When we look at the 2020 third quarter earnings, they were 49 cents. That's up 5%. Now, I'm actually looking back at this too, and I question my own numbers right here for just a moment, because I think that that's probably going to be more of 2020 second quarter earnings, but I'd have to check on that just to be sure. But I do know that their earnings are up 5% for the past quarter. Now, we can verify that by looking at the graph that's in front of you. And what you're seeing here is a graph that shows earnings per share stretching back to 2014. The dark blue line is representing the actual earnings per share, and the dotted line is going to represent the estimated earnings per share. And most of the time, they've actually succeeded in, if I can spit it out there, they have gone over top of the estimated earnings in most quarters, except in the last quarter in itself, they were under what the expected earnings are. And when we look forward, though, we know that what Enbridge is saying is that they are projecting higher earnings going forward. Okay, let's look at actually what's happened to the value of the stock, because we can talk about earnings all day long, but we want to look at actually what the value of the stock is and what it may be going forward. If we go back a year, we turn back the Wayback Machine to December of 2019. Actually, that should be December the 22nd rather than the 9th. It's at $36.83, almost 84 cents. When we look at the 23rd, which would be, actually, that should be the 22nd for today. Geez, I've got all kinds of numbers in there. Let's get this going a little bit better. Okay. Here's the whole story. When we look at Enbridge price at $36.83, compare that to today at $31.90, it's down 13.4%. Now, if you're looking at the graph, I'm going to describe it to you who are listening. What we're seeing is we're seeing a graph of Enbridge, and we're seeing a graph also of the Dow Jones U.S. Oil and Gas Index. When we compare those two, we see that over the past year that the index is really off about 37.56% compared to Enbridge, which is only down 13.4%, which is good. That's good. Yes, it's never good to lose, but if you look at the fact that it has actually done better than the industry in itself, that's good going forward. If we go back, though, and we look at this over a period of, let's say, 3 years, we go back a little bit further and we can see that the price is at $31.69. Now, that number is wrong. That should actually be 2017. But what it shows is that the price is really pretty stable from the standpoint it hasn't grown in value. You might be asking yourself, well, how the heck am I going to make any money on this stock if it's not growing in value? Stay tuned, folks, because we're going to talk about the dividend, because the dividend is a significant part of how this stock grows. When we look at the earnings per share, this comes from Enbridge's third quarter presentation that they put forward. And you can see over here in the graph, it shows a graph of the West Texas Intermediate crude just tanking. But the thing that continues to grow year after year with Enbridge is EBITDA. That's the earnings before interest, taxes, and depreciation income. Okay, let's keep on going on. And as I have to remind all of you, the past performance of any of this is not going to be a guarantee of the future results. And I want to emphasize that, especially when we talk about guidance from the company. The midpoint guidance for Enbridge that they put out says that they're implying a 6% increase in their EBITDA. And that would be reflected also on the graph that I just showed you just a moment ago. When we look at the midpoint distributable cash flow guidance, they're saying that it should be increasing by about 4% over top of 2020. Now, here is one of the best parts of Enbridge.
The beauty of your side.
For those of you who are just listening, that little musical interlude was just to introduce the fact that Enbridge has an 8.0% forward dividend. That is a significant dividend for any company. And if you're looking for income, this is a good place to look for it. And we're talking about strength. We have another sponsor, and I just wanted to emphasize them. That's Advice for Life Insurance. So if your family needs protection with life insurance, you can find the best life insurance at the lowest price in less than 5 minutes at adviceforlifeinsurance.com. Okay, let's look and see what the bulls and the bears are saying about Enbridge. The number one thing that a lot of the bullish analysts are saying about Enbridge is that their Canadian oil sands pipeline project is going to benefit from projected supply in the future. Oil sands is just a different type of oil source in itself. Some people might refer to it as bitumen. Bitumen is a separate thing than different oil, and not to get into a petroleum education, but if you have tar on roads, that's not really tar, that's bitumen. If you have shingles on your roof that are made from a petroleum type product, it's probably from bitumen in itself. The second thing is that is working to Enbridge's advantage is that regulations assure that cash flow is going to be continuing on a regular basis. Regulation also really bars competitors in itself, and they have growing dividends, which is a really big advantage when you look at the company and how it grows. Now, I have to caution you, though, it's not in the bear aspects of this, but if you're looking at this stock, remember that those dividends, in most cases, unless it's going to be in some sort of a retirement plan, are going to be taxable income to you. Now, if we have the potential for higher taxes on capital gains, this would be a good stock to look at. Now, what are some of the bearish analysts saying? Number one is going to be environmental regulations on the crude pipeline. That could be hampering cash flow in itself. Limited projects also limit growth. There's only a certain number of pipelines that are out there. There's only a certain number of projects that can be out there. It's not unlimited. Once that's fulfilled, it's hard to have other processors or other areas that are going to grow. Dividends could possibly also slow due to further and proposed U.S. regulations. It could also slow because of investments in alternative energy sources. Now, Enbridge has put more money back into developing alternative energy, hydrogen power, gas power, wind power, a lot of other different renewable energy sources, but you have to look at those things take investment and they can be a drag on dividends. Now, here's one of the better parts of Enbridge's value right now. With a price of $31.90, when we go to analysts like Morningstar saying that this stock is fair value is at $43. So what's that tell us? Morningstar's opinion is that this stock is trading close to a 26% discount. And when we look at what some of the other analysts are saying, most analysts are saying that this stock is they're saying that this stock is a strong buy. Out of 12 analysts, 11 of them are saying that this stock is a strong buy. And I would really concur with them. Although you have to determine if it's going to fit into your portfolio and your risk tolerances in itself. You can't just take what I'm saying for granted and say, go buy it because Van Richard said to, because I didn't. You have to determine that information for yourself. Now, let's see how this company competes. Remember, we started off talking about the stability, the moat. We talked about the earnings. Now, let's talk about the competitiveness. How does it compete with companies that do something similar? A Houston company called Enterprise Products is probably the closest competitor to Enbridge. Now, if you're just listening, I have on the screen right now a spaghetti graph with about 5 different investments, 5 different stocks that are graphed out there. And what it's really showing is that Enbridge and Enterprise Products are pretty close to each other. You'll see that Enbridge is actually not going to be the one that's on top. There's a company which is a competitor called TC Energy, and then there's Kinder Morgan too. But you're going to see that most of them move pretty close to each other. Now, what are some of the actual analysts saying about Enbridge? Wells Fargo probably has the most let's say, conservative viewpoint on this, but with the stock that's trading at $31.90, their target prices are in between 44 and 46. So that shows you that the companies, the analyst opinion is that this stock is undervalued right now. The most optimistic projection out there right now is from Stifel Nichols, which is between 61 and 59. So they too think that this stock is really pretty undervalued from that standpoint. All right, as we move forward to our last screen, I just want to kind of wrap things up and say, I want you to remember that when we're looking at any of these stocks, the stability, the earnings, and the competitiveness is really what we're trying to analyze. And that's what we've done today with Enbridge. So hopefully this has been helpful to you. Remember that stay tuned after this for the disclosure. This will be the last presentation that I do before Christmas. I'll see you after Christmas. So hopefully everyone has a great holiday. Stay safe and stay healthy over top of the holiday, and have a very Merry Christmas. Have a great weekend.